Hello everyone. Purpose of this recording is to, discuss some of the main points in Chapter 2. As you're working through these 5 chapters, you should make sure that you're going back and looking at the material from the earlier chapters. Don't treat these as individually, mutually exclusive chapters within the book. Everything builds on what came before it. And the purpose is when you get to the 5th chapter and get to the point where you're really starting to look at relationships described in ratio form, you really have to understand the interrelationships between the different financial statements, between the line items, again, both within and between financial statements. It becomes very important because when you're describing to someone the performance of a particular firm, you don't want to just describe things to them. You don't want to just say, well, they have this much cash, or they made that much in net sales, or this is what their cost of goods sold, or it's very basic information that an educated user could look up on their own. What you really want to be able to provide is some context, some maybe interpretation. What have you gleaned from reading the management's discussion and analysis, the notes to the financial statements, other outside sources of information that you may be privy to? What does that tell you? What light does that shed on what you see happening within the financial statements, both within a particular fiscal year and across fiscal years? That's what really people are looking for when they look for an intelligent, thoughtful, concise financial analysis. And so that's what you want to be working towards. So as you move into Chapter 2, the specific topic here is the balance sheet. There are 2 other ways to, describe or name the balance sheet. Many companies call it the statement of financial position, and some even refer to it as financial condition. And the reason why they do that is because you're looking at, one, the status of the resources, the obligations, and the equity in the firm. So you're looking at this is your assets equals your liabilities plus owner's equity. Remember, for obligations, the firm is obligated to 2 different sets of individuals. Those that are creditors, they've extended debt to the firm, and those that have purchased an ownership interest. In the corporate form, ownership takes the form of shares of stock. Shares of stock do not entitle you to any special access to decision making or access to corporate sites or any of that. It really is ownership in terms of you have a vested interest with them, with each other, in the financial performance of that firm moving forward. And so what you are entitled to is pretty limited. It's not like being a partner in a business that is a partnership or having a sole proprietorship. So it's a very different form of ownership. Okay, so first, as I always try to tell students, make sure that you understand what you're supposed to get out of the chapter. So I strongly encourage you to go and read the learning objectives for the chapter. They are listed right up front at the beginning when you hit the chapter there, because this is going to tell you, okay, what is it that I really absolutely must walk away with? And so these are the points that you need to walk away with here. So explaining content and purpose, preparing and understanding a common size balance sheet, which we'll talk about in a minute, listing and describing asset, liability, and stockholder equity accounts. Remember, each of these elements, the asset, liability, and stockholders' equity, those are considered elements. And then within those elements, there are accounts. Then you need to be able to analyze accounts receivable and the allowance for doubtful accounts to assess earnings quality. We're going to do a specific problem related to that. I'm going to do a separate recording where we're going to walk through a problem in the back of this chapter. The other area that you need to focus on is comparing the effects of FIFO, LIFO, and average cost inventory methods on the financial statements. I plan on doing a problem on that and sharing that with you as well. And then finally, understanding the differences in depreciation methods and calculate depreciation of fixed assets using straight line and double declining balance methods. Time permitting, I will do a recording that will walk you through one of those problems. Again, what each of those has in common, accounts receivable and the allowance for doubtful accounts, inventory valuation methods, and the topic of depreciation, is that they're all estimates. And that's important to keep in mind. You know, what you see on the financial statement isn't always necessarily hard and fast. You can't necessarily put your hands on it. In a traditional sense, in terms of the value. You know, yes, we can go identify that so-and-so owes us money, but the value of it on the financial statements, on the balance sheet, is what's up for question. Then the last two, evaluate the asset, debt, and equity structure of the balance sheet. So we're going to get into a discussion of something called liability. We're going to get involved in liquidity and solvency. Those are going to be two important topics. And then identify qualitative issues on the balance sheet that may be a concern. Okay, so we want to look at any potential problems that crop up. So those are the things you're going to be focused on. A couple of things you need to remember here. One, balance sheets can be called classified balance sheets. Classified balance sheets mean that they are put in some kind of an order. Remember earlier I told you, and I think in a previous recording, that balance sheets are organized by assets, liabilities, and equity. That within assets there are current and there are non-current assets, and they are also ordered in terms of liquidity. So the most liquid cash gets listed first, and then the least liquid, which would be things like your prepaid expenses and some, you know, maybe if you happen to own art and things like that, those are not very liquid. And so you would order them in terms of liquidity and in terms of time, current and non-current. Over on the liability side, you're doing kind of the same thing. You're doing it in terms of current and long-term. And then within, say, current, you are ordering the payables in terms of when they're coming due. So it's how liquid are they, meaning how soon are you going to have to pay them off. Under the long-term liabilities, you're going to have your notes and bonds and loans that extend beyond the current year. The thing you have to pay attention to with the long-term liabilities is that there is likely to be a current portion of those, meaning that if you have a loan outstanding, a portion of that loan may be due in the current year, and that will show up under current liabilities as the current portion of the long-term loan payable. And then the balance of it that's due beyond a year will remain a long-term liability. And then over in equity, those are just ordered. Typically, you're going to start off with your stock, common stock, different forms of stock, and we're not going to get into a full discussion of this, but it's basically shares of stock and how they're valued, any additional paid-in capital, things like treasury shares, your retained earnings balance, dividends, all those kinds of things that occur on the equity side are going to show up. And the more complex the capital structure of the firm, the more complex the reporting is going to appear when you look at a firm's balance sheet. Another thing you should keep in mind, there are two issues, measurement and valuation. Measurement has to do with the monetary unit assumption. If you remember from Chapter 1, we talked about different accounting principles. Well, the monetary unit assumption is one of those principles. And so when you hear the term measurement, frequently they're talking about what are you measuring it in terms of? Inches, feet, yards, miles. In this case, is it dollars, or is it rupees, or is it pounds? Well, what is it? Is it the euro? So measurement has to do with the monetary unit assumption. Valuation is how much. So in terms of whether, it doesn't matter what the unit of measure is, but it's how much of that particular unit of measure. And so for valuation, you're going to hear of several different types of valuation methods. One of them is called historical value, or actual cost. That refers back to what you actually paid for something. There's fair value, and there's market value. Fair value is what someone's willing to pay you for it. Market value differs from fair value in that market value, there is an established active market that kind of sets the price for the item. There's also something called net realizable value. And net realizable value, by way of example, would be like accounts receivable. Accounts receivable, there is a gross amount that you are owed. But you have this allowance for doubtful accounts, which is an estimate of what you don't think you're going to collect. And so you have a net amount that you're reporting. That's an example of net realizable value. How much do you actually expect to realize? Hey, you may be owed $100, but you may suspect you're only going to collect 80 of it. So that means you have an allowance account for $20. So the gross amount of accounts receivable would be 100. Your allowance account would offset it by 20, and so your net accounts receivable would be $80, and that's the net realizable value. There's also discussions of carrying value and book value. The carrying value tends to be the net value that you see on the books, and book value tends to mean the same thing. So you can see when you, say you have a building, and the building's been depreciating over time. Well, when you're looking up the value of something, you could look up the value as the original cost of the building, say $250,000, or you can look at its current carrying value, which is less the depreciation that's been taken on the building. So maybe the building has had $150,000 of accumulated depreciation, and so therefore the carrying value of the building is like $100,000. So its original cost is $250,000. The book value ends up being $100,000. Going back to the fair value issue. Now, I told you with market value, that's established by an active market, kind of like the New York Stock Exchange. But it doesn't necessarily have to be. Cattle, there's a market for cattle, and so if you want to know what the value of a cow is, you can easily find that out if you happen to know where to look. So in determining fair value, you have three levels. The first level is that there's observable evidence of the value, meaning active market quotes or history of transactions that are recent enough that you can use them for comparative purposes for the same thing. The second level for determining fair value is that you have observable, but it's not market quotes. So there may be few, or there may not be many current transactions, and they may not be for the exact same thing. And so you've got some things that are observable that you can use to establish a value, a fair value for something, but it's not the exact same thing. So it's one step removed from that first level. So it's still providing some observable evidence to base your value estimate on, but it isn't as good as having active market quotes or recent transactions for the exact same item. The third level is unobservable, meaning that they're based on assumptions and estimates used in models developed by the organization. So the reality is that is the weakest evidence for determining fair value, but it may be the only evidence that's available because there are no active markets or recent transactions for the exact same thing, and there may not be other forms of observable evidence or data, such as transactions involving reasonable proximities, something similar. So those are your fair value estimation methods. Again, we talked about issues, concerns related to liquidity. Liquidity has to do with its relationship to cash. So an asset or a liability's relationship to cash. The closer it is to being cash, the more liquid it is. So really, if you think about it, it's a timing issue. Cash is already cash, and so it's very liquid. Accounts receivable is owed to you in the form of cash, but it isn't cash yet. But it may be cash within 30 days or less. And so you might say, well, that's pretty liquid. It's not completely liquid, but pretty liquid. Inventory, on the other hand, is a little bit less liquid because you've actually got to have a seller. You have to actually sell it to somebody, so you need to have a buyer for it. And so that's a little bit less liquid. Solvency, on the other hand, has to do with your capital structure. And by capital structure, I mean, are you raising funds through debt or are you raising funds through equity? And in raising it in debt, what you're doing here is you are using your credit. So say for your current side, you may be using payable credit for a lot of things. For long term, you are using notes, loans, or bonds to raise funds for capital projects. You never want to mix and match. You never want to use long-term debt to fund current operations. If you're going to use long-term debt should be reserved and used for capital projects, long-term projects, major asset acquisitions. Okay? So how much debt versus how much equity is where the question of solvency comes in. Okay, what I'm going to do next, because I'm trying to limit the length of these, is I'm going to talk to you next about Exhibits 2.1 and 2.2. We're going to look at the balance sheets for Sage Inc. in the next video section. So, thanks again.